Okay, entry C. We have always told the employees if the company does well, we'll make sure that they get part of the action. And so we have declared a bonus of $10,000. Now, we're not going to pay that bonus, and remember that we're doing these entries sometime in January, so we're certainly not going to pay the checks back in December. All we're doing is showing that we owe this bonus. And once we declare a bonus, we have 60 days to pay that bonus by law. Okay? If we don't pay it within 60 days of declaring it, the IRS says we have to forget it. Okay? We have to reverse it, is what they say. Years ago, businesses used to declare bonuses and never tell anybody and never pay them, but still get the tax impact, okay, by setting it up as a liability. The IRS said, you can't do that anymore. If you're going to declare a bonus, you got to pay for it and pay it in 60 days, or else, reverse it, okay? Now, see, if they tell you they're going to pay a bonus, can they change their mind later and not pay it? If they don't declare it and don't tell you how much it is, they just say our intention is to pay it, yeah, they can do that, okay? You certainly, you have a right to go back in and civilly sue them for it, but that's a major hassle. And you may or may not win. Okay? Okay, what entry did we make? What did we debit and what did we credit, Steve?
Well, we debit the bonus expense.
Okay. Very good. Debit bonus expense, $10,000. Credit payroll payable. We didn't worry about the taxes. Why not? All the taxes we're going to have to withhold. Why didn't we worry about that? Do you know? We don't worry about the taxes until what happens? Until we pay it. So when we write the checks to pay that bonus, that's when we're going to have to worry about all that withholding. Okay? Entry D. Not only did we give our employees a bonus, but we gave also our directors and officers a bonus. Okay? And that was $5,000. So make the entry to record the officer's bonus for $5,000. Who were the officers probably? Yeah, it was probably the business main guys. Okay? Okay. What's the entry? Let's see. Rayma, what'd you do?
Bonus expense, $5,000, payroll payable.
Debit or credit to bonus expense?
Debit.
Debit.
Sorry.
That's good. Yeah. Okay, debit bonus expense, $5,000. It looks just like the other one. The amount's different, right? I separated them out because I wanted to take an opportunity to explain something to you. One of the big concerns about C corporations, you remember I told you this is a C corporation, and you'll see why I know that in just a moment. But one of the big problems with a C corporation is that they are subject to what's called double taxation. Any dividends paid to shareholders are taxed both at the company level and also at the shareholder level. So, what's that?
Why?
Well, because of the way it's calculated, one, and because for a corporation, a C corporation, the IRS statute, or the taxing statutes do not consider dividends as a deduction, okay? Or as an expense or reduction in taxable income. So let me just give you an example of that. Let's imagine that we have a net income to a corporation of $50,000. Okay? And we decide to pay all of that in dividends to our shareholders. So dividends, in other words, our cash account might have gone up by 40 or 60 or around $50,000. So we said, let's give that all to the shareholders. Now, who's making this decision? The board of directors, right? Who are likely, who else? The shareholders. Who are likely, who else? The officers. Okay? And so they're saying, let's give ourselves the $50,000 out of the corporate bank account as dividends. And if they do that, the actual increase to cash is a lot less than $50,000, isn't it? I mean, they probably paid out everything that they collected to the shareholders. And so their changing cash might be that they didn't have They paid all the cash out, right? Well, see, the problem is that the corporation is going to be taxed on this $50,000 at their own rate because they're taxed. They're a taxed entity. And the shareholders are going to be taxed at the $50,000 they receive. And so the same dollars are taxed twice. Big corporations don't have a choice. They've got to give out dividends. Okay? Why? Because you can, the way around this is to pay bonuses instead of dividends. See, now, if to those, the officers, we gave not dividends, but bonuses out, okay, guess what? We're taxed on the net income, or the corporation is taxed on the net income after bonuses. So in this case, it would be zero. So the corporation doesn't have to pay any taxes on the bonus. Now, of course, the recipient would. That bonus income would be W-2 income, just like my other salary. So I would pay taxes, but I only pay taxes once. Does that look a little bit better?
Oh, yeah.
What's that? Yeah, it would be. It would be a very, well, it depends upon what my other income was with it, okay? But that's a way to overcome that, and C corporations can do that. And C corporations have some advantages over S corporations. And so you get the best of both worlds by just using bonuses. Now, here's the reason why big corporations can't use bonuses. Because bonuses can only be given to employees. You know, you look at IBM, most of their shareholders are not employees of IBM, so they can't give them a bonus. So you could tell the shareholders, hey, we're not going to give you any money this year. And what's going to happen? Next shareholders meeting, which could be held the next day, they're going to choose a different board of directors, okay, that will give them a dividend. So they've got to treat the shareholders right. They've got to declare dividends. So that doesn't work with big corporations. They're going to always be giving dividends. But in small corporations, which most corporations are closely held, maybe one or two shareholders, three shareholders, they're usually also the board members. They're usually also the officers. And so as officers, they are employees and can be paid bonuses instead of dividends. Is that better?
You bet.
Yeah. Good ways to get around that. That's why I wanted to bring this up. Okay,